Welcome to our weekly market update. It's Friday the 26th of June. My name is Chris Marshall, Head of Investment Strategy here at Dragon Investment Managers. So as we head into Friday's trading session, we see that most of the major equity indices are just carrying with them a very small loss for the week. But that doesn't really tell us the full picture of what's been going on. Markets have been very volatile and very choppy, as they have been really for the past few months. There's certainly still an awful lot of volume going through them. So I have a few points I want to draw out that we've seen come through, which might explain some of that volatility. But first of all, I want to just take us back to March. Of course, March was that period in time when lockdowns were just coming through in Europe and the US, and we saw a lot of fiscal policy coming through from governments to try and support those laid off and to try and make sure that not too many were laid off in the first place in the hope of a fast recovery. I want us to concentrate on the US. The US introduced the CARES Act, and this did two main things. It upped the unemployment benefit, and it also gave a payroll support program that could be used to try and make sure that employees stay on the books of companies. Now, one of the reasons I bring this up is, of course, these are only temporary measures. And one of the things we're now seeing, or starting to think very closely about, is that these really come to an end at the end of next month. And the real economy is nowhere near ready. In fact, yesterday's initial jobless claims, which again is the second week coming in higher than expectations, we see that still over 1 million people in the US were filing for initial jobless claims. These are still extraordinarily high numbers and very telling of what's going on underneath. This then brings me to another story I want us to think about, and that is the IMF came up with revised estimates for GDP. The IMF, of course, being just one of several global bodies who produce GDP forecasts and quite well respected for them. And what they're saying is they revised them down. They see that the economy will recover much slower. And without going into too much detail, essentially what they were saying was we shouldn't see the same level of GDP, the same level of production in the economy, if you like, until we get to the end of 2021. Now, that recovery projection is very, very different to the one that the equity markets are currently pricing in, and equity markets are actually pricing this in with very little room for error. When we start looking for error, of course, it's quite easy to see this. We've seen geopolitical tensions rise, not only between US and China, but actually between US and Europe. Those are starting to ease slightly as we move into Friday's session, but it's worth knowing that they're still out there. The other is, of course, we've seen the US banks be stress tested by the Fed. This is a regular thing which happens to make sure that they have, in the Fed's eyes, sufficient capital to weather a storm, just like the one that we're in right now. Now, most of them, I believe all of them actually passed with sufficient capital, but the Fed did impose some measures which prevented share buybacks. Not just for Q2, but into Q3, as well as talking about capping dividends. So these are some significant measures which just show us that still the real economy is still very fragile. Now, the other thing that is of course cropping onto our screens and coming into our thinking is, of course, the increase in US cases. Now, there's two theories behind this. One is that because the lockdowns are easing, people are gathering together and the spread of coronavirus is happening that way. And of course, the other theory is that there's been a huge increase in testing and therefore more cases are just being identified. But either way, we're seeing the highest, newest new cases of coronavirus that the US has seen throughout the whole of this pandemic. Finally, I want to just touch on the appetite for the market for fixed income instruments. And this time we turn our attention to Austria. Austria has a 100-year bond. They have done for several years. But the interesting thing which happened this week was they issued a 100-year bond, and for the first time it was below 1% yield. Now that's very significant, because if you're tying your money up for 100 years, you would expect to be rewarded quite handsomely, especially with all these stimulus measures, which could, of course, lead to inflation. So what this bond issuance tells us, it was issued at 0.88%, is it tells us that the market is simply not worried about inflation in any form whatsoever. Now, in the near term, we would agree with that. There seems to be more deflationary pressures as there's an excess capacity, and certainly as unemployment rises, but we are also seeing a direct increase in the monetary base, which historically would be very inflationary in its nature. Those inflationary pressures, of course, are likely to come through when we come back to normal employment levels. So these are some of the things which markets are just trying to work out what's happening and also apply to how this might play out. Now for us, we've been saying that the real economy recovery is going to take time. People are going to have to be patient. The central banks did a great job taking out liquidity risk in financial markets, and the stock markets rallied off that. But now it does seem that equity markets perhaps are getting a little ahead of themselves and also starting to really look for more and more stimulus. And so some of these announcements yesterday spurred on markets in the final few hours as the hope for more stimulus was coming through. For us, the catalyst for a real recovery is, of course, the movement of people and people getting back out into society. And so looking at high frequency data, we are still seeing that improve. And this will be really one of the big metrics that we continue to look at to really establish which direction we are going in, and is there a real improvement in that data. So from myself and all the team here at Dragon, thank you very much for your time, and we wish you a very healthy and happy weekend, and we will see you again next week for another market update.